All right, we are live. All right. So we are looking at valuation of common stocks. Valuation of common stocks. Common stocks are just the same as ordinary shares, ne? Common stocks is just the same as ordinary shares. So you just need to know. Remember, when it comes to the valuation of the company, we look at three aspects. Just to feed you up, we look at three aspects. We've got debt, right? We've got debt, and then we have got equity. So a company is funded by either debt or equity. Right? Debt, that would mean people are borrowing us money, right? And we need to retain that money. And equity, this is where you actually buy a stake within the company. So when you buy a stake within the company, remember you're bringing in money, right? So that's why we call it equity, right? So we've got debt and equity. We've got those two categories, but on the side of equity, you can further break it down, right? You can further break it down into preference shares and ordinary shares. Preference shares and ordinary shares. All right. So what we looked at last time on the valuation of bonds is part of debt. Right? Bonds, that was part of debt. We were actually looking at the valuation of debt. And then what we are looking at now is the valuation of common stocks, which is the ordinary shares. All right. So that's what we are going to be covering. There's most of your exam questions, what I've looked at is they normally like to bring questions on ordinary shares, right? They normally like to bring questions on ordinary shares. So you really need to, especially when it comes to valuation of bonds and stocks, you really sort of need to know your story when it comes to the valuation of common stocks, like what happens, what needs to, in terms of formulas and all of that. All right, so we're looking at valuation of common stocks. Important equations. We've got important equations that we need to master or know. All right, we've got this equation. The first one, right? This is basically for one period dividend valuation model. Don't worry so much. I'll go through it step by step. Right? I'm not going to present it like last week. I know last week you only presented a few. So here I'm going to go through one by one, so that at least when you see a question from the exam, you are able to like capture, oh, this one is about this one is about that. But this is just to summarize the equations that are important. So for one period dividend valuation model, I'll even explain what is the dividend valuation model, what are they talking about. And then this is the formula for multiple period dividend valuation model. This is for the zero growth dividend valuation model. This is for constant growth dividend valuation model. And then this one is for non-constant growth dividend valuation model, right? So don't worry much about this. You'll actually find that it's going to make more sense after we're actually done with the questions and everything. Yeah, so don't worry much about trying to understand it now. All right, let's quickly move on to, this is the first part. I want you now to switch your attention to this one. Right, this is the first one. When you look at share valuation, right, we have got stocks that we call redeemable. These are redeemable stocks. A redeemable stock is a stock that you buy from a company, right? Or in this case, remember, these are ordinary shares. So you buy ordinary shares within a company, but there is a set date, right, in future where you are going to redeem or to sell these. So it's like you buy shares within a company, and then you say maybe after 2 years, you are going to sell these shares away. So that the date is certain. And the question would always specify, right? Not necessarily the date, but it will also always specify in terms of what we call they will normally talk about the par value, right? That you bought some shares in a company and the par value was so much, and you are planning to redeem, or you are planning to sell them maybe after 2 years or after a year. They will always specify in the question. You will actually see examples that we are going to be dealing with here. So when it comes to share valuation, you need to be able to identify that, is this stock redeemable or is it not redeemable? So a stock that is redeemable is a stock that you buy within a company with the purpose of reselling after a certain period. It could be after 1 year. Some they buy shares today and at the end of the year they sell them. Others they buy them today and after 2 years they sell. So you always need to know what is the period, right? So we're going to look at the first one where we look at share valuation. It's redeemable, right? And for every redeemable share, that is the main formula, the one that you see above there, right? Present value of year zero, P0 is present value of year zero, is equals to present value of dividends plus present value of the selling price, right? So that's how you actually calculate the share, the value of that stock or the value of those shares. Present value of the dividend of which the dividend you are always given in the question, and the selling price you're also always given. And I'll tell you how to spot the selling price. All right. So here, first and foremost, we are looking at what we call single period valuation model. A single period valuation model, this is a situation whereby you buy a share or shares today, or you buy some common stock today, and then after 1 year you sell them. So that's why it's called a single period valuation model. Single period in terms of you're only going to buy the shares now, and then after 1 year, you sell them away, right? That's why they call it a single period valuation model. So the valuation is dependent upon the year of dividend, and after 1 year sale of shares. So we're only looking at 1 year. So it's very simple. It's very, very basic. Nothing is complicated. All right. So going back to the formula again, remember the main formula is this one: present value of dividend plus present value of selling price. Né? But you'll find that it's the same as what we have here, right? Present value year zero is equals to, this is the present value of the dividend, because this D1 is talking about the dividend that you're going to get at the end of year one, right? And I'm sure you are now familiar with this part, right? PVIF, this is present value interest factor. KE represents rate of return or cost of capital or the discount rate, right? So we call it KE because it's basically K represents cost and then E represents equity. So you're basically saying the cost of equity. If you looked at last time when we were looking at bonds, we called it KD, which is the cost of debt. So this one is the cost of equity, which is the percentage that you will always be given in the question, right? Remember the rate of return, discount rate, what else do they call it? Cost of capital. Yeah, that percentage, the one that you use in your textbooks, right? And then if you look after, I put a comma and then there's 1. So that 1 represents 1 year. Remember, this is a single period valuation model. So we're only looking at 1 year. Right? So we're looking at the present value of the dividend. It means we have to take the dividend at the end of year 1, and then we call it, we multiply it by the present value interest factor. Remember here we are using table 2 because it's just a single amount. Right? We are using table 2 because it's a single amount. And then we say plus P1, this is the selling price. This is the selling price at the end of year 1. right? Selling price at the end of year one, which will always be given in the question. So we also multiply it by the present value interest factor, KE, and also year one. All right, so it's very basic, it's very easy. Let's quickly look at a question that wants us to apply that. We have a question there, and it's saying ABC equity stock expected to provide a dividend of 2 rand and market price of 18 rand a year hence, right? What price will it sell for now if the investors required rate of return is 12%? So if you look at that question, it's telling us about the dividend, right? ABC equity stock. The moment they talk about equity stock, you know they are referring to ordinary shares. Ne? ABC equity stock expected to provide a dividend of 2 rand and the market price of 18 rand a year hence. So both the dividend and the market price are supposed to be at the end of the year. Now, one thing you always need to know is if you go back to this formula here, where it talks about present value of a dividend, right? If you look at the dividend that we have, it's the dividend at the end of year one. So you shouldn't find yourself. I think we are going to look at a question. This one it might be silent on that, but what I want you to know is that the dividend that we are looking at always is the dividend at the end of the period. Don't look at the dividends that you are currently having now, right? So in this case, if you go to the question, it's telling us that the equity stock expected to of ABC is expected to provide a dividend of 2 rand and a market price of 18 rand a year hence. A year hence meaning at the end of the year. What price would it sell for now if the investor's required rate of return is 12%? So if you look at it, it's very basic. Remember our table, right? So in the first column, right, I'm not really going to put a year, right? Because remember, I'm dealing with the dividend and I'm also dealing with the selling price, right? So what I would basically need in the first column is the information on the dividend and the information on the selling price. All right, and then I have my amount column, my calculation column, and present value at 12%, which is basically the same thing we've always been doing. Now, first and foremost, remember our formula says we need the present value of the dividend, right? So I need my dividend year one. And I'm told that my dividend is 2 rand, right? So I just put 2 rand there. And then I need to actually give the present value of that dividend. So I'm taking 2 rand, I'm multiplying it by the present value interest factor. Yes, there you are. And remember, it's table 2. We are looking at table 2. So if you go to your table 2, column, a column that is 12% and a row that has got 1, you would find that the factor, you find that it's 0.893. Ne? So you just multiply your 2 rand by that factor, and then you put your present value at 12% as 1 rand 786. Right? I know we are dealing with rands, but you're still allowed, because remember you're still calculating. So it's at your choice, right? If you put it as that present value, ne? If you put it as 1.79, it's still allowed, right? If you put it as 1.79, it's still allowed. Remember, here it's not really, you shouldn't really worry about this. Just like I explained last time, we call it the margin of error, right? So if you put it at 2 decimal places, it's still fine. If you want to put it at 2 to 3 decimal places like I've done, it's still allowed, or as long as I know that my final answer is going to have 2 decimal places. So it's still okay. And then, so I'm done with my dividend. I have provided the present value for my dividend. Ne? Now I move on to the selling price. We are told that the market price of that stock it's 18 rand after 1 year. Right? So that becomes my selling price. So I know if you look at the way I've written it, I've said selling price, but selling price is the same here as market price, right? And then it's 18 rand. So I'm going to be selling it at the end of year 1 at 18 rand. Whoever wants to buy this share would have to give me 18 rand. Né? So I'll come here. I missed 18. I'm supposed to put 18. So it's going to be 18 rand multiplied by the present value interest factor, 12% year 1. So it's basically the same factor as the one on top. So 18 rand multiplied by 0.893, and then I'll get 16 rand, 16.074, or you can put it as 16.07. Right? You always need to be careful if you are going to put it to 2 decimal places. You always need to know how to round off your figures. Né? If the figure that you have after the second figure is more than 5, then it has to change the other number. But if it's less than 5, you just leave it like that. All right. So my price or value of stock now will be 1.786 plus 16.074, which is basically these two amounts. And then I'll end up having 17 rand 86. Hi, Naledi. How are you? Good. So I'll end up having 17 rand 86. And that's my price or value of stock. Oh, okay. Oh, okay. I'm going to be comfortable there.
Yeah.
Okay. All right, so we've got 17 rand 86. Any questions here? Any questions on how we came about this answer? Remember, this is a single value, single period valuation model, where we look at it's a stock that is redeemable in the sense that we buy shares in a company for the purpose of reselling. Right, so the date of reselling is already set. We know that we're only going to have 1 year, and then after 1 year we sell these shares, and then so whenever you're looking at a redeemable stock, first and foremost, you need the information for dividends, and you need the information for the selling price. You get the idea? Like I've highlighted here, every time you're looking at share valuation for redeemable, you always need information for the dividend, and you always need information for the selling price. Selling price, why? Because we're going to sell it. All right. We're still going to look at other types of shares which are not, we call them they are not redeemable. Right? They are irredeemable. You cannot, there's not a set date. So which means you are buying this stock just for the purpose of keeping it within the business. That's why you find when it comes to stocks, buying shares and all that, there are people who are buying stocks for the purpose of resale. They are basically trading. That's their profession. They buy shares and then they resell. Others, they just buy shares and they keep them for as long as they want. Yes, a question from Jabulile.
Okay. You said before year 1.
Yes.
It's the dividend is 2.
Yes.
Selling price is 18. Then after a year, then that's when we've got 1.7.
All right.
Is that
so this is what's happening. At the end, you've bought some stock, right? But you are not really told like how much you bought it now, right? So it's silent on that. Basically, that's what you are calculating. But then you are told that if you are going to buy this stock at the end of year 1, if you buy this stock today, At the end of year 1, you're going to get a dividend of 2 rand. So that is at the end. Remember, we are talking about between now and at the end of year 1. So at the end of year 1, you're going to get a dividend of 2 rand. And then you're also going to be able to sell this share for 18 rand. So altogether, you are now having how much? 20 rand altogether. And that 20 rand constitutes the selling price and the dividend. So you're now being asked, what is the price that you are willing to pay for this share now? If your required rate of return is 12%. So now what you now have to do is to look at these 2 rand that you're getting. Remember, you're getting it at the end of year 1. So what you need to do is to bring it back to now. What is the value of these 2 rand now? So the value of these 2 rand now is 1.786, right? And then we were also told that you're going to get 18 rand if you sell this share, but you only get this 18 rand at the end of year 1. So you still need to also bring this 18 rand back to now. And then you are told that it's going to be 16.074, right? So now the value that you are willing to pay for this share now has to be 17 rand 86. What are we saying? We are saying you are willing to pay this amount. Any amount above that amount will be too costly for you. It's too high. So it's basically giving you advice to say a share like that, which is going to give you a dividend of 2 rand and a selling price of 18 rand at the end of year 1, the maximum price you're supposed to be willing to pay for it has to be 17 rand 86. Anything higher than that is now going to be too expensive for you. So you are now you now have a choice to say, no, if it's going to be above that amount, I'm not going to be paying for it. Yes. But if it's going to be less than that, let's say they are selling it at 15 rand. That's why these guys who are trading, this is where they make profits. That's where they are able to negotiate. So I'm supposed to be paying 17 rand 86, but I need to make profit here. So I'm negotiating a lower price. So if that guy, or if you buy it at, let's say, 15 rand, which means you're going to be making profit. Yes. So for those that are trading, I'm sure you are getting tips. All right. Naledi, are you fine? You're okay, ne? We were just looking at the first one. You just came in at the right time. Share valuation redeemable stocks, right? This is where you buy stocks that are supposed to be redeemed after a certain period. So here, the period that we're looking at is only 1 year, right? We call it a single period valuation model, right? For shares that are redeemable. All right. If there are no further questions, let's look at the second one. This is still share valuation that is redeemable. This is a share that we've bought, or stock that we've bought from an organization, from a company, but we're still going to resell. All right, we still want to resell, but we're not just going to do it after 1 year. We call it a multi-period valuation model. This is whereby you buy the share or the shares today, but you're only going to sell these shares maybe after 5 years or 4 years, right? Having kept them in the organization. So the formula, the general formula is still the same. We still need the present value of dividends. This time is going to be dividends because remember there are different dividends, in the years. And then we still need the present value of the selling price. All right, so the formula we are going to have here is present value of that, the dividend, present value interest factor, annuity. Present value interest factor, annuity, because remember the dividend that you are getting is most likely to be one and the same dividend. So like if you buy some shares and they tell you that the dividend is going to be 20 rand, so you're always going to be getting 20 rand out of that stock, right? And then at the end of a certain period, you're supposed to be getting a selling price, and we need the present value of that selling price. So valuation is dependent upon more than 1 year of dividend, and after that selling price of shares. All right, it's going to make more sense when we look at a question. It's going to make more sense when we look at a question like that.
Excuse me, where do you get this question?
I'm actually getting them from my notes, because they are not in the exam papers. Yes. So I'm getting them from, remember the notes that I promised to send the other time? Yes. If you actually go online, you'll also find the same questions within the notes. Yes. Jabulile, you wanted to ask?
Just go back to
the previous slide.
Yeah, I've noticed that the formula.
Yes.
Now on the first formula, it's having a PVIFA.
Yes.
And the second one is PVIF. That means we are using two tables, table 4 and table 2.
Yes. So the reason why we have, remember, this is present value interest factor annuity. Why? Because you have bought a stock in a company and you are getting the same dividend for all the years. So let's say you are getting a dividend of 20 rand. It will be 20 rand for first year, 20 rand second year. So the amount is the same for all the years. That's why we are using the present value interest factor annuity, which is table 4. And then, but then the selling price, you're not going to be getting the same amount all the years. It's an amount that you're only going to get after maybe so many years. So it's a single amount, and if it's a single amount, remember you only use table 2. If it's a single amount, you only use table 2. All right. Can we look at a question? When we look at a question, it becomes more simpler. All right. So we have Mr. Ali. Mr. Ali held 20 shares of par value of 100 rand each. So this guy has got 20 shares. He bought 20 shares from a company, and each share has got a par value of 100 rand. It has a par value of 100 rand. So the par value, right? This is another term you need to understand. If I issue out shares today, they normally issued at what we call par value, right? And this par value, the value does not change. The par value means if you are going to sell these shares, you're going to have to sell them at that price. That's what we call the par value. So I can issue out some shares, and I'm saying I'll issue them at a par value of 100 rand. So that 100 rand means if you are going to sell these shares to the public, you're going to have to sell them at that value. We call it the par value.
Oh, so the par value is the selling price?
Yes. Basically, it's actually a selling price. So that's why I said I'm going to teach you on how to take out the selling price. So the moment you see par value, that becomes the value that you're going to sell your shares at. In this case, we're told that it's 100 rand. So now, dividend for first, second, and third year are expected in the amount of 3, 4, and 3 rand, 4 rand, and 5 rand 50 per share, respectively. And after that, share redeemed at face value. Calculate the value of stock if discount rate is 13%. Now, this is where you need to be careful, because if you check the formula here, was assuming that we might be getting a similar dividend for all the years. Right? So if you are getting a similar dividend for all the years, then yes, you will have to use the present value interest factor annuity. But look at this question. It's not giving us the same dividend for all the years. The dividends are different. But we are still told that this is a redeemable stock, and it's going to be redeemed after, where is the information? Yeah, it's after that share redeemed at face value. You get the idea. So at first we are told that Mr. Ali held 20 shares of par value, 100 rand each. Dividend for first, second, and third year are expected in the amount of 3, 4, and 5 rand 50 per share, respectively. And after that, the share is redeemed. So the moment you see here, the redeemed, we know that, oh, they are going to be sold just after how many years? After 3 years, right? And they are going to be redeemed at face value. What is face value? Face value is the same as par value, one and the same thing. Face value and par value is one and the same thing. After that, share is redeemed at face value. So calculate the value of stock if discount rate is 13%. Now, I want you to be able to maneuver questions like this, right? You need to be able to take from the question what the information that is relevant, and then you apply it as per what's needed. So if you look at it, what we have here, dividend year 1, we are told that it's 3 rands. And then dividend for year 2, we are told that it's 4 based on the information that we have. And then dividend for year 3, we are told that it's 5 rand 50. And then the selling price, when is the selling price? Selling price is supposed to be at the end of year 3. That you also need to know that information, right? You need to know the year in which you're going to calculate you're going to have your selling price. In this case, we're told that it's year 3, right? So selling price, it's year 3, and then we're told that it's 100 rand. All right, this one is quite easy. We now know what's happening here, right? We are using table 2. Why are we using table 2?
Because the dividends are different.
Because the amounts are different, right? So that's why we are using table 2. But if the dividend was the same, let's suppose if the dividend was 3 rand up until year 3, what were you going to use? You're going to use table 4. You'll just take the single amount. You'll just say dividend year 1 to year 3, and then you just put the amount, and then you just take that amount multiplied by the present value interest factor annuity, and then you put the factor, and then you get your present value. But here, because the amounts are different, it means you need to separate them and use table 2. All right.
So which means with table 2 you need to specify each and every
Yes.
amount.
You need to specify each and so that you can get all your marks.
Okay.
Yes.
So with annuity, only one.
Only one. All right, and then I'm sure here it's quite easy, it's quite basic, right? You know where to get these factors. Table 2, 12%, and you use the rows for year 1, year 2, and year 3. And these are the factors, and then you get your present values at 13. Remember to use 13%. Now, on the selling price, you do the same, 100 rand, present value interest factor, 13%, year 3, and then it's the same factor here, and then you get 69.30. Then after that, you're supposed to then calculate. Remember another thing, this is where you need to be careful, right? This is where you need to be careful. Let's go to the question. The question is saying, calculate the value of stock if discount rate is 13%. Ne? Now, all this information that we are calculating here is amount per what? Per share. And how many shares does this guy have? 20. So most of the time, you'd find that you're going to leave your answer like you'd only add this, and this, and then you leave it like that. So you always need to be careful. We are calculating the price or the value of stock, and how many shares are they? 20 shares. So what you'll do is you take 20, the number of shares, multiplied by this plus this plus this, because this information, all this information was the value per share. So this is value per share multiplied by 20 shares. You always need to remember to multiply by the number of shares. That is, especially in the if the information is telling you that a person has held so many shares within the company. And then the question is now saying calculate the value of stock if the discount rate is like that. But you'd find most of the time, the question is always asking you the value per share. What is the value per share? What is the value per share? So if the question is always asking you about the value per share, then you won't obviously need to multiply by 20. So you always need to be careful about that part. Most of the time, I'll repeat, most of the time, the questions are always saying, what is the value per share? So if it's a value per share, you won't necessarily need to multiply by 20 or the number of shares that you're given, right? And then, so in this case, I'm adding this plus this plus this plus this, which is the information that I have here. And then I multiply by 20, and then I'll end up getting 1,577.9. So this is basically the value of that stock. This is the value of that stock. Now, remember we are calculating the value, the present value, and present value means now. What is the value of that stock now? So you're only willing to pay 1,577.98 now. Anything more than that is too expensive for us. Anything less than that, then we are going to be making profits. Any question? So this is a multi-period valuation model, but remember the stock is still redeemable. It's going to be sold at a certain date. In this case, we are looking at a stock that has been there for 3 years. So first and foremost, you need to check, are the dividends having different amounts? If they are having different amounts, use table 2. If they are having the same amount, just use table 4. You apply by the same amount. But remember also still to calculate the selling price at the end of the year in which the stock was sold. Any questions? So remember, it's always important to look at, to identify the year at which you are going to have your selling price. So in this case, we are having year 3 based on the information that we are given here. All right. So remember, these are shares that are redeemable. Redeemable meaning we buy stock for the purpose of reselling. All right. Can we move on to shares that are not redeemable? We call them irredeemable. Irredeemable shares or irredeemable stock. Irredeemable stock. All right, so irredeemable stock, this is the valuations are done. The valuations are done on the basis of what we call on the basis of the dividend, and the method we use there is what we call dividend discount model. Dividend discount model. So remember, with the redeemable shares, you had to include the information on the selling price, right? The selling price of the shares. So now, because you're not buying these shares for the purpose of reselling, so it means the information on the selling price, we don't need it anymore. Because remember, you don't want to sell them. You just want to buy to keep. So the only information you're going to be using is the information on the dividend. You work on the dividend alone, right? That's the only information that you basically need. So that's why we call this method the DDM. It's called the dividend discount model. This dividend discount model. You are no longer going to be using the selling price because the stock is irredeemable or the stock is not redeemable. All right. So we use the dividend discount model, but now the first one we are going to look at, just like with the redeemable. Remember, it came in 2. We had the single period and then the multi-period. Right. So with this one, we're going to look at what we call the zero growth. Right, the zero growth dividend discount model. And this is where, like, this is the formula. Present value of your stock will be the dividend over the cost of equity. This is the most basic or the easiest of them all. Right? If you find a question like this in the exam, this is free marks for you.
What's this O on your formula?
The O is 0 actually. You are basically saying present value, year 0. Present value, year 0 is equals to dividends over cost of equity. Dividend over cost of equity. So just like I said, this is the most basic and most the simplest of them all, because you just need to find information on the dividend and information on the cost of equity. Once you have that, you just divide the two and you get your answer. Right? So this is the simplest, just like I said. Let's look at a question and see how to apply it. A stock pays a 12 rand dividend annually. Right? So this dividend does not change. It's the same. Right? Stock pays 12 rand dividend annually. If your opportunity cost is 15%, and that's another word for rate of return. You see, they keep on bringing these terms, sometimes just to confuse you. Right? So the opportunity cost is 15%. That's your rate of return or your cost of equity. How much is this stock worth to you? So if you look at that question, it says nothing about redeeming this stock. It's silent. It's just telling you that you get a stock that's paying you a 12 rand dividend annual. Every year, you're getting the same dividend of 12 rand, right? So it's not saying anything about redeeming the stock. So once you see an information like that, then you know that it's an irredeemable stock. All right. So yeah, yes. So we have in terms of the answer, this is my given information. My D, which is dividend, is 12 rand, né? And then my KE is 15%. And you need to present it in decimal form, 0.15. Right? 15% is 0.15. And then my P0, or present value, year 0, is going to be 12 rand divided by 0.15. You just punch that in your calculator and you get your answer. Now you just punch that in your calculator and you get your answer, and it's giving us 80 rands here. So if you punch 12 divided by 0.15, you should get 80 rands. Any question? Any question? Anything that you do not understand? So this is a zero growth. Zero growth in the sense of the dividend is not growing. The dividend is remaining at 12 rand throughout. So it's 12 rand, 12 rand, 12 rand. If it was a redeemable stock, we're going to use that method of saying present value of the dividend, but using the present value interest factor annuity.
So in this case, we don't use present value annuity.
You're not going to need that. Yeah, you're not going to need that because of look at the formula. The formula is telling us that we just need the information on the dividend and we divide by KE.
Right? So what if I can use it without that I don't answer? What in case, sometimes in the example, you're confused, you want to finish, you go to
yes. So
table 4.
Yes. So thank you for bringing that up, because I know a lot of people might want to do that. The moment they see 15%, they're already opening.
So why is it that we must maybe conscientize ourselves to say, I mustn't use the table this time. I must use
Thank you for that. So the formula is going to guide you. Right? The formula is going to guide you. Now I want you to compare the formula that we have there. Okay. Look at the moment you see present value interest factor annuity or present value IF, you know these are tables. Right? And another thing you also need to know, this is also going to be your guideline. When you're looking at a share valuation which is redeemable, you know you're going to have to use tables. You don't have a choice.
So that's what I'm asking.
Yes.
We want a formula, remember?
Definitely, yeah.
There's no formula that's going to guide us.
Yeah.
So we need to highlight exactly what is it.
What, yeah.
Yeah, from the question.
From the question.
That's true.
Say, how would you see from the question?
Yes.
What exactly should you look at?
That's true. So the moment you see the it's a share valuation and it's redeemable, then you know you're going to be using tables. Yeah, you're going to be using tables because of the PVIFA or PVIF interest factor and all that, right? And another thing, it's just like I said, what you need to know, because I know, since, like you said, you're not going to be using formulas, but it's an open book, ne? So it's a matter of, obviously, how can I put it? I want to put it in a sense that it's going to be easy for you. Say we're looking at share valuation, right? And that's why I've actually given you important equations, right? You should go with these in the exam, knowing, okay, these are my formulas that I'm going to apply, right? So if you check, we're already on this one for zero growth dividend valuation model, right? So you should already know where to apply this based on the question that is given, right? So now I want you to look at the which question was it? This one. ABC stock expected to provide a dividend of that and that and that. Just based on this information, you already know that, okay, I need the present value of the dividend, right? Like Ujabulito was asking, what is this 2 rand? This 2 rand is something that I'm given at the end of year 1, right? So I need to calculate the present value now. And then how do I do it? I do it like this. But remember, there's also something which is the selling price. I also need to bring it back. So how do I do it in a single way? Now remember, I'm also presenting it in a table form. If you look at my table, it has got the same structure throughout. I can present all this information in a different format, right?
Like
And
myself, I don't use tables.
yes,
It works better for me.
that's true. So you'll find that I can present this information in another way. So the reason why I'm keeping on using tables is so that you don't get confused, and you don't get to ask, why are we here? And so I want you to like stick to one formula, a formula that I know you're going to be able to get all your marks. You get the idea. So if you look at the structure of my table, it's more or less the same, right? Now, if you go to this question now, a stock pays a dividend, a 12 rand dividend annually, right? And then they are telling us that your opportunity cost is 15 rand. So I know there is a temptation to say, oh, this is the same amount, right, throughout. But you need to ask yourself a question: which year am I looking at? Because remember, for you to use tables, you need years, and we don't have information about years here. So it's something that should just, as you are thinking about tables, you should always be asking, okay, I need a column for the percentage, but I need a row for the years. But I'm not given years here.
We hear you.
Yes.
But we'll be in an exam.
I know.
We'll be in an exam room and time will be ticky.
Yes.
Creating some years for ourselves.
So the more we ask you, maybe you must forgive us so that
it's fine. It's fine. Yeah.
Just stay somewhere.
Yes.
Yeah.
Please do ask me. Please do. I'm actually happy that you're asking these questions, because remember, this is time for us to, how can I put it? Let's make all the mistakes we can here now, but we can't afford to make those mistakes in the exam. Yeah. So please ask questions if you do have. Please ask. Yes.
With the dividend, is it always going to be like at the end of the year? Must we always just assume that the dividend is at the end of that year? It'll never be.
You are very right. The dividend you are going to be looking at, your question, you find that is actually going to be answered rightly in the question that we're going to look at now. Right. So the dividend that you are looking, like in this case, when they say a stock pays a 12 rand dividend annually. These are dividends always at the end of years, and we are not told how many years. So this is basically a stock that is bought, but it's going to stay in the company for perpetuity. We don't know how long. Right?
So,
So,
why do you remember, what do you call it? When you ordinary and preference shares.
yes.
Is it the same?
So this one, what we are looking at now, this is basically remember it's under the topic of unless if the question, because normally if it's a preference share, the question always specifies. That's another thing you need to notice. Say if it's an ordinary share, it will normally say it like that. A stock pays a 12%, a 12 rand dividend annually. So if it's silent like that, then you know it's an ordinary share. But if it was a preference share, it would specify that this is a preferred stock. Now it will tell you that this is a preferred stock or it's a preference share. Yeah, but if it's silent, it's just silent, as you can see. A stock pays a 12 rand dividend. Then you know it's an ordinary share or it's ordinary stock.
Because I remember the example that he gave was saying ordinary shares, you get the dividends.
Yes.
It doesn't change.
Yes.
That's
Yeah.
what we must know.
Yeah.
Preference shares, it fluctuates.
It fluctuates,
and
yeah.
You can get the money, it depends on how the company did.
Yes.
Yes. So
Yes.
maybe it's something that we must.
All right. So let's. Yes, a question.
Another thing.
Yes.
For just my
Yes.
information.
It's fine.
Whenever they are selling shares, do they specify that this is irredeemable or this is the redeemable shares?
Yes. So, I'm going to answer you in two. Sometimes they specify, sometimes they are silent. Like in this case, it's silent.
Okay.
You see, it's not saying anything about redeemable or unredeemable. It's silent,
Yes.
right? So it says a stock pays a 12 rand dividend annually. If your opportunity cost is 15%, how much is this stock to you?
Yeah, but it tells you.
You see?
But I would say, I would say it's irredeemable because it doesn't say anything about a selling price.
Yes.
Like
Yes.
if they maybe,
So once they are saying selling,
you know it's
Then you know
redeemable because
it's-
you have to
it's-
sell
it's-
it.
Like,
redeemable. Yes. Yeah. So it's how can I put it? It's like sometimes as much as we try to put it in a box, it is a way of So you need to still apply your mind. All right. I'm not saying it's a difficult thing to do. Like if you look at this, a stock pays a 12 rand dividend annually. If your opportunity cost is 50, so already there's nothing that's saying we're going to sell this share. So it should then tell you that you're basically going to use this formula because the dividend is got a zero growth. It's not growing. It's still 12 rand, and I'm given my opportunity cost or my rate of return. So if they are going to ask me about the value of that stock, I'm just going to use that formula there. Yeah. All right. So it will just be the dividend. In this case, the dividend is 12 rand. And then the KE, which is the cost of equity, is 0.15. So you just divide the two, and then you get your price.
Okay.
Yeah. Then you get your price. So another thing is, remember, that's why I always emphasize on especially after this. Ne? If I give you further questions to try, and then you do them, it becomes so easy. Yeah. Yes, practice will always make perfect. That's why I'm always emphasizing on put it into practice. Do it 3 times. You'd find that it's easy for you to capture anything. Oh, this is that. Okay, I'm doing it this way. Yeah.
Another thing, my suggestion.
Yes.
When we prepare for exam, on the answers, write 3 answers. Just saying like this. Write one formula, the second formula, the third. Then when you open your
your question paper, yeah.
Just like what you understand, come back
Yes.
and recheck. Because time, the problem is time.
Yeah, those 3 hours will seem like it's 3 minutes.
Yeah.
And then come back. Look
Yes.
at what you have. I think that is the best way.
That's
Unlike
true.
you go and you want to do you panic.
Yeah,
By the
that's-
time you spend 30, you
I
can't
will-
spend
I will
30
die.
minutes
I will
on
die.
what you
I will die.
You cannot.
Yeah.
That is, you cannot, not one patient. And many, we do that.
That's true. That's true.
30 minutes. You wish like after what's here.
Or you wish you could just hear the voice. All right. So remember, this one is for zero growth, ne? Zero growth, where the dividend is the same throughout, but it's irredeemable. The next one, it's still irredeemable, but there's a growth there. The dividends are growing each and every year, right? So we call this the unlimited constant growth, right? Unlimited constant growth. Remember, the first one was the zero growth. So this one, the unlimited constant growth, where it keeps on growing at a constant rate, right? So I'll also show you by this question how to capture that. But this is the formula you basically need. Now, to answer your question level, look at the formula. We are saying present value for year 0 is equals to D0. D0 is actually what we call the current dividend. What is paid now? So it's D0. But in our calculations, the reason why we are saying D0 multiplied by 1 plus G, we are actually saying the dividend you are getting now plus the growth, because obviously the growth is going to be put at the end of the year.
Yeah. So
now, what you actually need at the end of the day, it's not necessarily D0, but D1, which is the dividend at the end of year 1. So you don't need the dividend that you're currently having now for any formula regarding stocks. The dividend information that you need is the dividend at the end of a period. That is the main assumption, right? And then, so it's going to be D0 multiplied by 1 plus G. I think we now know what this means. This means we are taking the current dividend and we are adding the growth.
Yes.
Over KE, which is your cost of equity minus growth. So what you just need to do, to be honest, the most important thing, especially you'll see with practice, you just need these figures. Once you get these figures and you are able to identify them in your question, it's easy to actually apply them in a formula. But let's quickly look at a question. Suppose you want to buy a share of a company which paid a recent dividend at an annual rate of 2 rand per common share. So there's a dividend that has already been paid. And this becomes our D0, dividend for year 0, because it's already been paid. And when you are coming in and you want to buy the same stock. So we are told that there's already been a dividend that has been paid of 2 rand per common stock or per common share. After talking to your broker, you expect dividends to continue to increase at 5% per year, like the past 4 years, right? So for the past 4 years, there's been a constant growth. Your opportunity cost is 12%. What is this stock worth to you? So coming back to the question here, Jabulile, you see, it's not saying anything about redeeming this stock. It's silent on redeeming this stock. So we know that if it's silent on redeeming the stock, we know that's an irredeemable. It means we are not going to sell it after we buy it. We're just going to keep it in the company. All right. And then, so look at my answer. I need information for D0. the current dividend. What is currently paid now? And then I'm told that it's 2 rand. That's my D0, which is dividend for now. Remember 0, it's now. And then I need my growth, my G. I'm told that you expect the dividends to continue to increase at 5% per year. So my growth is 5%. Now be careful when you put 5% into decimal. When you convert it to decimal, it's 0.05, not 0.5. I know because of anxiety in the exam and all that, you end up writing 0.5. Right, so it's 0.05. And then my cost of equity, it's 0.12 because it's a 12%. Once I know that I have all this information, I know I can get my answer regarding this formula. So I'm just going to put everything. P0 is equals to 2 rands multiplied by 1 plus 0.05, which is my growth, remember? And then I have my KE, which is 0.12 minus 0.05. So this is equals to 2.1. This is the answer I get from here. 2.1 rands divided by 0.07, 007. All right. I got it from here. Then I divide these two, and then I get 30 rands here. So this is basically my price per share, because my information is regarding a share. If you check here, they're saying, suppose you want to buy a share. So this is the price per share. Because there is a constant, an unlimited constant growth, you are expecting these shares to keep growing at a constant rate of 5%, right? So I'm not told about years. Remember, these years, the 4 years, they are past years. And when I'm buying a share, I need information about the future, right? So don't get confused about these 4 years. Oh, where am I going to put 4 then? Right? Yeah, where am I going to put 4?
That is written on the question, you want to use it.
Yes.
The problem is, the challenge is, you don't even know where to start.
That's true. So remember, the information that you need is, whenever you're looking at share valuation, think about the future. That's why even the information on the dividend, we don't even need the dividend for now. We want the dividend for the future. How much am I going to get in the future? Right? So you apply your formula like that, and then in this case you get 30 rand. So any if they are going to price this stock maybe at 40 rand, you don't buy it because you are buying something that is too expensive. You can only buy it, the maximum price you are willing to let go of is 30 rands. Anything 30 rands or less, then you can buy that. Any questions? So this is an unlimited constant growth. It's the dividend. Remember, what we are looking at here, it's a share valuation, and we're looking at it's irredeemable. We are not going to sell it. So you forget about the information on the selling price. Your focus is on the dividend. The question now is, how is this dividend treated? In this case, the dividend has got a constant growth. It's keeping on growing at a constant rate of 5%. So this becomes your formula. There is a G now, and this is how you put in the G. This is how it affects your formula. You'll find that it's more or less similar to this one, right? It's just that we now have a G, a growth, but it's more or less the same. Yes, a question level.
Arthur, so in the exam,
Yes.
when it comes to the redeemable shares, it'll always be about the period, whether it's single or multi, whatever.
Yeah, they'll always tell you.
Then the irredeemable will be about zero growth, or if there is growth. Like those are the kind of questions we must expect in the exam.
That's true. That's true. So with the redeemable, it's the redeemable, you need to be about the years.
Yeah.
Is it 1 year? Is it 3 years? When am I going to sell? maybe the question you should always be asking, when am I going to sell my shares?
Then you know. Okay.
Then you know the number of years you're dealing with, right? The question will always specify. But with irredeemable, it's not going to tell you about years. Right. Remember, you are buying this stock to keep it. So information about years and all of that, it's silent, right? So far we have dealt with this one, the two that we've looked at. They are quite basic, but we're also going to look at another one which talks about we call it a limited constant growth. A limited constant growth. Now, this one is popular, right? This one is popular with the examiners. They like this kind of a question. So if you are going to be studying and you're going to be focusing, put much of your attention here because they like it here. They like this kind of stock, right? A stock that is irredeemable, but it has a limited constant growth. It has a limited constant growth. So let's look at it. The valuations are done on the basis of the dividend, which is the dividend discount model. Dividend discount model is a limited constant growth. This model assumes that the dividend payments are growing each year at a constant rate of G for a limited time. Remember the previous one, you know that it's 5% until, but this one it will tell you that it's going to grow at 5% for the first 6 years. And then after that, it's gonna grow maybe at a lesser percentage. Now, the assumption will always be, and the reason why they like this question, especially in the exam, is because in the real world, it's mostly like that. Obviously, when you want to buy shares, right? They use something to lure you to buy that kind of a share, right? So you want to buy a share that is giving a certain dividend. So they will tell you that for the first 6 years, it's going to be growing at a percentage that is higher than the inflation rate. You get it? So you'll be attracted to such kind of a stock because you'll be thinking, okay, for the first 6 years, I'll be making huge profits, right? But after those 6 years, then it comes back to a percentage that is below the inflation rate. So that is used to basically lure you as an investor, so that you can you can purchase such kind of a stock. Let's look at a question, and then we'll go back to and fro if you've got questions. Please remember to ask questions. Ne?
Can you go back first?
Can I go back first? Yes.
Constant rate of what? Growth for limited time.
Yes, for a limited time. The previous one was for unlimited time, but this one, there's a limited time for the growth.
Okay.
All right. So, are we fine if you can look at that question now? So, suppose that a company's dividends this year is R1.20 per share, right? Suppose that a company's dividends this year is R1.20 per share, and that dividends will grow at 10% per share for the next 3 years. The appropriate discount rate for the company's common stock is 12%. What is the value of a share? Look at the question. What is the value of a share? So it's telling us about just one share. But if there were many shares, always remember to just, whatever final answer you get, you multiply it by the number of shares. All right. So now, remember the current dividend is standing at R1.20. This is D0. Dividend for year 0. It's standing at R1.20. So now, what we need is, for year 1, we are told that, first and foremost, can we read the question again?
Yeah.
Suppose that a company's dividends this year is R1.20 per share, and that dividends will grow at 10% per year for the next 3 years, right? So we're looking at our D0, it's at 1 Rand 20, and we need to put the 10% growth, right? So it's going to be 1 Rand 20 multiplied by 1 plus 0.10, and then we get 1.32. So at the end of year 1, we are going to end up getting a dividend of 1 Rand 32, right? Let me quickly move on to this part. Now, because remember, I'm trying to get the present value of all the dividends. This will take me to the tables because of the limited time. So do you see what's happening? Previously, the time was unlimited. So if the time is unlimited, I don't need to use tables. But now here the time is limited. We are told that for the next 3 years, our dividends are going to be growing at this rate. Oh, 3 years. Okay, so there's going to be year 1, year 2, year 3. So I can use my tables. Yes, ask questions.
Now, the challenge is,
Yes.
now that we used to say when the amount that doesn't change.
Yes.
So we know that, and if there is no anything that shows that we must go to the table, we must do 0.10. So the confusion now comes back.
Yes.
We go back to the table, or is meaning?
Yeah, no, yeah.
It's yeah. Let's discuss the real concerns.
Because remember, like earlier, what we had like concluded was if it's redeemable shares, we'll use tables. But now
Yes.
we're busy with irredeemable shares,
Yes.
and we're still using a table.
Yes.
So when it comes, so must we then like remember that when the only time we will use tables with irredeemable shares is if it has to do with if there's growth in the company, but it's limited.
Yes.
Like it's like, or like what we need, like it's like how are we going to remember when to use a table when it's irredeemable shares?
That's true. So this is a real challenge, ne?
Yeah.
And I would actually agree with you that it's a difficult thing. Or when do I use my tables? When do I not use my tables? Now, if you look at the previous one, right? The previous question, we are looking at a share valuation. It's irredeemable, and we didn't have to use tables because of the unlimited time. Right? So remember what we said earlier. Sometimes if you try to put these things in a box, they have a way of getting out, and you're trying to catch it again and all of that. So at the end of the day, what you need to do is to, how can I put it? You still need to apply the mind based on what the question is telling you. All right. The reason why I went back to this one is I want to look at the way the question is structured. Here they're telling us that suppose you want to buy a share of a company which paid a recent dividend at an annual rate of 2 Rand per common share. After talking to your broker, you expect the dividends to continue to increase at 5% per year, like the past 4 years, right? Just similar to the past 4 years. Your opportunity cost is 12%. What is this stock worth to you? So what you need to identify from this, remember that's the reason why I've also separated it. Because here we are looking at unlimited constant growth. Unlimited in the sense that there's no time attached to it. So each and every year up until perpetuity means forever, sort of. There's always a constant growth on your dividend. Now, imagine if you were to use tables on that. So I want you to come to a point where you're saying, I want to use tables, and you have unlimited time. So already it's telling you that tables are out of the picture. That's number one. So I'm trying to get you to a point where you sort of get signals, right? It's unlimited constant growth, and you know that you're not going to be able to apply your table. That's number one. Number two, you always need to remember your formula for such a scenario.
This is a two sides of a coin again.
Yes.
Where we fit in again the limited time in terms of time.
Yes.
Time.
Yes.
So there's unlimited, there is limited. So we need to also be able to highlight the fact that it talks about unlimited constant growth and
Yes.
limited one.
Yes.
So how do we see
That it's unlimited.
Okay, where they say increase at 5% per year.
Per year, like the past 4
And
years.
then the limited one, how do we see?
The limited one, let's go now to that's why I'm comparing the two questions, so that you're able to see the difference.
Okay.
So this one is telling us that there is an increase, or even if you check here, it's saying you expect the dividends to continue to increase at 5% per year. And it's not telling us it's going to stop.
Yeah.
So it's going to continue to grow at 5% per year, full stop. It's telling me that this is an unlimited constant growth. But look at this one now. Suppose that a company's dividend this year is R1.20 per share, and that dividend will grow at 10% per year. It does not stop there for the next 3 years. So it's telling us that this 10% is only applicable for the next 3 years. After that, no more 10% growth. So this is a constant growth for a limited time.
Mm-hmm.
But where am I getting this information? I'm getting it from the question. Another skill which you're going to have to, that's why I'm saying, you see, now we have all the time to look at all these things. But by the time you get to the exam, you should have already sort of developed that skill. It's when you are reading a question, right? Don't just read it at face value, right? Read a question, but in mind you are looking for certain information that is going to be relevant to your answer. Yes. So the moment
that's the reason why we want to understand what we must look for. You know, whatever you're teaching us, you're teaching us to be able to understand.
To understand, yes. I so much wish that we could put this in a box and we say, when you see this, then you just do this. But you find that it comes in different shapes. So I don't want you to look at it once.
The suggestion that I said.
Yes.
We have maybe 7 days before we write November.
Yes.
It's 7 November.
Oh, yes.
So what we can do is to write, like, if you under valuations, you can write different questions on valuations, put them together, so that when you open, you don't take a book unless you're gonna use it. It's only for the table. Don't open the book. It's gonna make. You also do the copy. Yeah. Then we write valuations, the questions that we had, similar questions like after we put them on the same valuation, paragraph. The second paragraph, it will be something else. So
you're allowed to do that, eh?
Yes.
Okay.
I mean, we do notes. You're allowed to do notes.
Okay.
So I think the best way is to group them together, so that when you get a question,
you know where to look.
And then you compare all the questions that you have, and then you know which one you can use.
That's
you
why
can get it.
You know what, man? Otherwise, distinctions.
Yeah, distinction.
You know what I think?
Distinction is a plus.
Yeah.
If I get 60, I'm okay.
You know what I think will be like the best thing? Because we must actually print all of these out. Because you see how Arthur has grouped it. You see.
You can still do it.
And then
you don't have to write them.
Yes, so we must print this out. And also the good thing is also, you know how you have the equations. So we'll know for evaluation of bonds, these are the
equations.
This is what we must look at. So we must actually print this and take it with us into the
No, we are allowed. It's like
okay. No, it's fine. So okay, let's finish this question.
Okay.
So the 10% growth is for the next 3 years, right? So we are looking at year 1, year 2, year 3, right? I'm not told anything after year 3, so my calculations have to end at year 3. All right, so I'm looking at the first one. I've calculated my dividend. I've added the 10%, ne? And then I put the present value interest factor, 12% year 1. Remember, I'm using table 2 because the amounts are different.
Okay.
I have 132, 145 year, and 15 something something. So since the amounts are different, I'm going to use table 2. 1 rand 32 multiplied by 0.893, I'll get 1 rand 179. Right? This is present value at 12%.
You see what the difference is?
Yes.
You only realize after you have done the calculations that the amount are different.
Yeah.
And that's where you can think about the table. you understand?
Yeah.
But the end of it, like, once you say, oh, it's 120.
Okay. So the next one will be 1 rand 20, which is our D0. We discussed actually a similar question like this. When was it? When we were dealing with capital budgeting, if you still remember. So you take 1 rand 20 multiplied by 1 plus 0.10 to the power 2, because you're now adding another. Okay, you're adding another 10% growth on top of the first one, right? So it's like you're saying 10% growth plus another 10% growth over the initial amount. So it becomes 1 rand 1 rand 45 or 1.452, right? And then we know this area, right? And then it will give us this. So you do the same with the year 3 initial dividend plus 10% plus 10% plus 10%. So that's why you're saying multiplied by 1 plus 1 plus 0.10 to the power 3, right? And then it will give you this amount of your dividend, 1.597. This area we are covered, and then it will give you this present value, and then you just add these 3, and then the value of your stock is actually the addition of these 3, and then you are good to go. Yeah, you are good to go. So it's a matter of knowing, like it's a stock that is irredeemable, but we have got a growth that is there for a limited time, and in this case it's 3 years. Then it means you basically need a table like that, and then you use your tables. But if they are not going to be if there is going to be unlimited growth, then you just use the previous formulas that we've looked at. All right. All right, so we have looked at an unlimited growth for a time. Can you look at another one? A mixed growth. A mixed growth. A mixed growth is, they also like this one in the exams. They like this one in the exam, and I think this one is actually the favorite. Now remember, they like the previous one, but this one is their favorite. Now this one is a mixed growth whereby they will tell you, they're saying this model assumes that the company and its dividend payments grow much faster than the economy for a certain period at the beginning, and then settles to a constant growth rate, right? So it's similar to the previous one. It's just now telling you that, okay, we have a 10% growth for the next 3 years, and then it tells you what happens after 3 years. It tells you after 3 years there's going to be a constant growth of so much.
Oh, so it's basically like an addition.
Addition, yeah, it's an extension, basically.
Yeah, we stopped after 3 years in the previous question.
Yes.
Now we have to go further.
Yes. Yeah. So with this one, we had to stop at year 3.
Yes.
And then that was it. But now with this one, we are now looking at what happens after year 3 going further. What happens after year 3 going further? Let's look at a question.
I can really see.
Yeah, but do you now realize the importance of when I say then, guys, do this question, it's because it only looks difficult because we are discussing it, right? Because sometimes when you're discussing something, it's more like you have opened a can of worms. You'll always be having questions that are popping up. So, but what if? But once you attend a question, once you start practicing, it becomes easy. It becomes easy. So the only time that we have, especially now that we're preparing towards exam, is the time during the week. The time during, I know you still have a lot of things to do, but the only way you're going to master, is if you. The only way you're going to master it is if you can attempt questions that I'll be giving you, and then the more you practice them, you actually find that it's going to be easier.
And it's true, eh?
Very true.
Accounting, if you don't practice,
yes.
You never know.
Yeah, and there are actually two levels to actually understanding it. That's why I'm saying, you see, these things you cannot put them in a box. So there are two levels of understanding it. This is the first level where you understand the theory, you ask questions of it. But the next level is the practice part. And you cannot really get the distinction we're talking about without especially Naledi. I'm actually expecting her to come up with a distinction. And Jabulile and Lebu and there. All right, no, it's fine. Let's look at this question. Suppose that Sun Corporation dividends this year it's basically a similar question that we've looked at. It's 120 this year. It's 120 per share, and that dividends will grow at 10% per year for the next 3 years, similar to what we have looked at. Followed, you see, it goes further. Followed by a 6% annual growth. So this 10% growth was only for a limited time, and that time was 3 years. And this 6% growth is from after 3 years up until, right? Until we call it perpetuity. Yes. All right.
Another name is what? There's perpetuity. There's another one.
Yeah, perpetuity.
Infinity.
Yeah, infinity. Yes. English. All right. So the appropriate discount rate for corporations' common stock is 12%. We're still using this very same percentage. What is the value of a share of Sun Corporation common stock given this information? So what I have here from here up until number 3 is what I actually have previously here. One and the same thing. Yeah? But let's now look further. What happens after year 3?
Oh, my apologies. So,
It's fine.
which one is this?
This is mixed growth now.
Oh yeah, let's mixed growth.
Okay.
Yeah. So remember the previous one was growth for a limited time,
Okay.
and now this one is a mixed growth, which is combining growth for a limited time plus unlimited growth further. Right. So let's. I said from year 1 to year 3, we are fine here, ne? No questions,
Yeah.
because it's just what we've just looked. It's just the same as what we've looked at, right? The present values, factors, and everything, right? The dividends, the growth, and all that. This was a 10% dividend growth, right? Let's move together to year 4. Are we on year 4? Let's put our focus on year 4. Now, remember, after year 3, that's where we're now going to say, from this point going into the future, we are going to be having a growth of what? Of 6%. Right? So now, what we need is the initial dividend, which we started with, plus the growth, 10% for 3 years. So what I'm basically saying here is that this amount of 1.597, you can basically take this amount and just replace it with this.
Yes.
Ne?
Yeah.
And then what I'm now saying is, further from this point of 1.597, I'm adding a further growth of 6%. Do you see what's happening? Yeah. So I'm adding a further growth of 6%. So that will be 1 plus 0.06. So I'm multiplying this multiplied by that. In other words, I'm saying 1.597 multiplied by 1 plus 0.0 to add the further growth of 6%. Are we together there?
Yeah.
All right. Then I'll then get this amount 1.693.
Yes.
So in other words, remember this 6% is going to be 6% after year 3 up until infinity. Right? Now, what we need to calculate, remember we call it the terminal value.
Yes.
Yeah, it's a common term now. We need to calculate the terminal value based on the formula of the unlimited growth. If you look at this formula of the unlimited growth, you'd find that it's similar to the ones we've been looking at. This one, unlimited constant growth. It's basically similar because we are looking at the dividend plus growth and the cost of equity minus growth. So I want you to see this. You see, D4, which is the initial dividend plus growth, which is D4, dividend for year 4 going onwards, over KE minus growth. It's basically the same. Right? And then I don't stop there. This is my terminal value, and I still need to calculate the present value of this terminal value because it's required of the formula. And then I put 12% and then I put year 3. So just like I always say, the factor you're going to be using here and here always have to be the same.
Yeah.
All right. Then here I'm now just replacing all this with the numbers, the real numbers. 1.693, which is this, divided by 0.12 minus 0.06. And then I put the present value interest factor 12% year 3. So what I'll get here, if I do my calculation, I'll get 28 rand 21. And then I'll just multiply it by the present value factor, which is the same as that. Always make sure that these are the same. And then I'll get a present value of 20 rand 20.09. Right? So that is basically the present value of my terminal value. And then after that, I'm now supposed to add everything from year 1 to year 2 to year 3 to year 4 up until infinity. And then my value of stock becomes this plus that plus that plus that, and then I'll get that 23.56. Now, this is their favorite. They like this question. So if you can master it well, you'll be good to go.
Typically, how many marks is this question worth?
Normally, because I already have I took an extract from October, question 3, October, November 2016. Right? It was a question on a question that is similar to that. Right? It was asking further questions and which we are going to deal with later. Right? But I would want you to look at this question. Right? I would want you to look at this question for now, and tell me if you are able maybe to attempt a question like that.
Which one? This one?
This one. Just read it through and see if you are able to apply it. Maybe you can even if I can even give you an opportunity to just scribble down somewhere if you are able to, and see if you can apply it. See if you can apply it. Try to apply it as quick as possible using the concept that we have just used now. Should I give you some clues? I can give you some clues just to help without looking at the answer now.
Let's just see.
Yes. Oh, okay. So we have dividends. They're saying the stock pays a dividend every year on March 29. So we are told that today's date is 30 March 2016. ePay in stock pays a dividend every year on March 29. The most recent is telling us that that's D0. It's the recent dividend name. It's 150 per share. So our D0, our current dividend is standing at 1 rand 50. So our D0 is 1 rand 50. You expect the company's dividends to increase at a rate of 25% per year through March 29, 2019. That's how many years? From March 30, 2016. So it will be March 30, 2016, 2017, 2018, 2019.
Okay.
So 3 years.
Yeah.
Right? Remember, today's date is 30 March 2016. So we need to go up until March 30, 2017. That will be year 1. 30 March 2018, year 2. 30 March 2019, year 3.
I first had 4 years and then I thought about it.
Oh, yes.
No,
It's 3 years.
Yeah.
Oh, it's
A question,
Yeah,
Jamali.
I was thinking if today it's 30
30 March, yes.
years.
So
And the dividend are being paid 29. That
Yes.
means we passed 2016.
Yes.
Mm.
So remember,
we're just looking at 2017. Yeah.
that's true. And remember, whenever you're looking at the dividend, this model, don't focus on the dividend that's paid now or the dividend that has already been paid. Your focus is on the future. What is the next dividend? Yes. What is the next dividend? So in this case, we have 3 years. Right? So it means this growth of 25% is only going to be up until March 29, 2019. That's for 3 years. Right? So you should already be having year 1, year 2, year 3, and you now know that you are working with an initial dividend of 1 rand 50. So you are adding your 25% for each year for 3 years. And then you do your present values for those dividends. Yes. And then it says after that, dividends will increase. You see, after that, after those 3 years. So it means you are going to go to year 4.
yes.
Right? After that, dividends will increase at 5% per year. Right? So it means you take the latest amount, the latest dividend, and then you put a 5% increase on that.
Okay. What my thinking was,
Yes.
I must add, and then the total of all the 3,
Okay.
and I do 5%. I don't know.
The total of all the 3 dividends.
Dividends, and then I do the 5% with the PV.
No, don't take the total.
Okay.
Separate them, because remember we are looking at the dividends individually. So you're basically saying, remember it's an individual amount for each year. So what we are saying is, you started at the first year we are looking at 1 rand 50 plus 25%, which is a separate single amount. Right? Yes, for year 1. Then for year 2 you add another 25% based on the previous one, and then for year 3 you add 25% based on the previous one. That's why we always multiply by we always put in the power sign, right? And then once you are at year 3, the latest dividend that we have at year 3, then you add 5%.
I don't add.
You don't add everything.
Because I think my thinking was
to add, yeah.
And then add 5%
Your total.
to the year 4.
Yes. So you look at it separately, take the dividend as a single amount, and then add the 5%.
Okay.
Yeah. I would have really loved you to write something. I don't know if I can still give you an opportunity to continue. I'll
When
just
you
give
say
you
write
a
something, what do you mean? You mean the answer, like we must do it like...
We thought we are just
I-
put the given information down.
Oh yeah, I actually wanted you to attempt that question,
Okay.
given this limited time, and see if you are able to apply your mind on that.
We have a reminder. You know what? Now when you want us to run, yeah, what?
Yeah, it's to give you a boost so that when you get home you'll be, you see, when you start with it in class now, when you get home you'll be more motivated to go back to it.
go
Say,
back,
I want to
yes.
finish that. I want to continue on that.
Which table?
See, I want to get you to a position where even if you are a person like Naledi who is saying, distinction, you will get in the exam and you won't have a choice but to come out with the distinction.
Table 2 never.
Yeah.
Which table are we using?
2.
Table 2, yes. Even if you are expecting a 60%, you will come out with 90. You will come out with 90. And please bother me during the week. Please bother me if you are happen to find time to revise this and you're doing it. You can send a WhatsApp message, and then okay, if I'm busy with something, I can always attend to it later. But I'm so happy with people who bother me and nag. Yeah, it's time to apply now. The concepts. Time for mistakes is now. Let's make all the mistakes now. So remember, when you draft your table, year 1, year 2, year 3, and the dividend for year 1, the dividend for year 1 will be 150 multiplied by. I'm confusing you now. Okay, I'm just gonna be quiet.
Lord Jesus.
It's interesting, eh?
I'm telling you.
How our brains function.
No, you remember other things when you're busy catching. Moving forward and then
Yeah.
you add them all together, ne?
Yes, Jabulinde, you can ask. Yeah.
No.
You need a clue. All right. Yes.
Can we compare, guys?
I'm still so far.
Not me, I just laughing thing. I didn't.
Okay, so here, this is year one, eh?
Yeah, no, I think I'm okay.
Which is
So,
always that. So
I
you
just
don't have
want
to apply this for now.
Oh,
Yes, you don't have to apply this. This one you only apply it in year four. Yeah.
okay, no.
It's fine. It's fine. I'm actually glad you are able to ask this. So this one you don't apply it for now. You only apply it. So you only take this. You apply it by the factor. You get the. Yes. You do the same. Then this other one, and so at year four, that's when you're going to apply that.
Oh,
Yeah.
Tell me.
Yes.
I don't know. I think I'm confused with where I need to divide.
Please ask. Please ask. Where are you confused?
What I did year 1, 2, 3.
Yes.
I from my 25% I get 155.
Yes.
I multiply by PV present value.
Okay. Let me come and see what you've done.
Just and see, because I'm not sure. I just do the work because I do what in my mind. I don't do what you did. So, 1 plus 0.25, 1.03. I multiply 150
By that.
by that, and then I got 155.
Yes.
And then I went to the
table.
table 2. I multiply here 1, 2, 3.
Okay. Let's first deal with this one.
It's 1 times.
This is the factor, no?
Yes.
And the factor multiplied by this, you got 1.24. And then year 2.
I did the same with 103. Don't mind this.
Okay.
I did all. So I didn't change.
That's where the change comes.
Oh, so
Yeah.
me, I didn't change.
Yes.
Where
Yeah.
does the change come?
Because I think.
Oh, because
Yes.
they say it's one amount, so I must just
On
do.
top of the other, yeah.
On
So
top.
it's no longer just the same amount here, 1.03. It will be, can I just indicate here? It will be 1 plus that and to the power 2.
Oh, I'm not doing it this side.
Yes.
I'm doing it this side.
Yes. So that's why I said you need to do it separately. Because if you try to combine everything, it's going to give you a wrong answer.
Okay, let's wait for others because I'm now confused. Because I thought you first need to get what for 25% each year, 1, 2, 3,
Yes.
and then when you get to year 4, that's where it's gonna change.
Yeah. No, it's fine. We'll look at the solution together. Let's see what you've done.
This is all my.
All right. 150. Okay, you did not include the 25%. Remember, this is D0.
Literally, this changes everything.
But it's fine. I'm actually glad that you're able to come across this. Because if we don't do this practice, it means you're going to do this in the exam.
Exactly. What's gonna happen?
Yeah.
We just saw it 2 minutes ago.
Yes.
But
2 minutes ago. You can do the same in the exam and then you'll end up coming with the
Okay.
But you see what you've done here?
This is supposed to be my year 1.
Yes. And then I think this is supposed to be year 2 and then yeah. So you remember your focus is not on the initial dividend. The initial
So
dividend
this was
is
supposed to be.
yeah.
Okay, I know where I went wrong, but I
I'm
can
actually
see-
glad you were
yeah.
able to pick that up. Yeah.
I can see where
And
I
then
went
that's
wrong.
when that's what helps.
So if I would just show you the answer, sometimes it will just be, oh, okay, I captured it. But sometimes when you put it into
That's
practice.
what you were training us to practice.
Yes. So that practice is very important. I'm just showing the importance.
You see now,
I see where I went wrong. I'm just lazy to go change everything.
Yes. Let's look at the answer now.
That formula on the first.
Yes. Let's look at the answer. Does it? Are you able to tell then where you got it wrong? So let's start with. Can I quickly see how you managed to correct that one, Jabulide?
This one.
All right. Yes.
This.
All right. Awesome.
Which means I forgot to do.
Yeah. Even if you got 2.94, it's fine.
94 years.
Yes. So your 2.94 is somewhere here.
But why
For year 2.
Yes. This is
Answer there.
year 1, year 2, and year 3.
So the year 4 must be.
This is my year 4 for 2020.
So you have to.
Oh, you know what did I do now?
Mm.
This 150. Yeah.
All right. So I'm going to explain right from the beginning.
Got one.
I can see I went wrong. Obviously the first one, and then I will also see where I went wrong. Never year 4.
Yes.
This
All right.
150 doesn't change.
But Alpha, why
Yes.
did I get the 1.03
1.03.
times 1 when I multiply by
You got 1.03 because you rounded it off to the
No.
nearest
1
to
1 plus 0 plus 0.25.
yeah.
I got 1.03.
Yes. So you rounded it off to 1 decimal place. You see what you have done? You have taken that 5 there. You see that 5 on 0.025. And you have used it to change these 2 and then it became a 3. I'm sure it's your calculator that did it for you.
Oh, it's my calculator.
Yes.
Because my calculation is when I say 150
Yes.
times 1.03. That's
Yeah.
why it gives me 155 that you saw. Then I go to the P.
Yes.
In
Yes.
fact, I'm correct. It's just that the calculator make me to do.
Yes. Your calculator gave you. It's not a wrong answer. It's just it has a bigger margin of error because it's now 1 decimal place instead of 2.
Can you help me to
Okay, I'll set it up for.
stop from
I'll set it up for you. Okay, let's start from the beginning. Your first step is to know the structure of your table. That's why I'm giving you more or less the same structure because it's going to help you with your time in the exam, right? Because some people they struggle just with the format.
Yeah.
Which format should I use? And it will take them 1 hour to figure out the format, right? So I don't want you to do that. I want you to this you can actually memorize the structure, right? Year column, dividend or amount column, right? And then we have the calculation column, and then we have the present value at 14%. All right. Then I have 30 March 2017. You can write it as year 1. It's fine. It's acceptable, right? 30 March 2017. This is my D0.
Yes.
I'm emphasizing. This is my D, and I don't really need my D0, right? I actually need my D1. D1 is the dividend at the end of year 1. But I cannot get dividend at the end of year 1 without information for D0.
Year 0. Year 0, it's not 150. Just
Yes, but remember in the column,
now
you don't need year 0. You need year 1, year 2, year 3.